there's been a lot of a lot of details in the news about SPACs. In fact, these are basically investment ticker symbols, right? And you can invest in these just like stock symbols. And a lot of people, especially technicians who don't pay attention to the fundamentals, they've been investing in these things. But you got to kind of understand, and the reason why it's been coming up in the news is because there's just so many of them out there in 2021. I mean, there's always been a few of these companies out there over the existence of the market, but they've like quadrupled and quintupled the number enough that they've got the SEC on edge, right? The SEC kind of cracked down on these guys in the beginning of the year. And then after the crackdown happened, they multiplied again. And this past autumn, there's been so many of them. And do we have a video of the SEC guy? Kind of, I think it's a 2-minute video. Can we play that video?
Yeah, we'll play it right now.
A lot of people are wondering what SPACs
are. What in the world is a SPAC anyway? Suppose a group of strangers came up to you and said, I have a company that doesn't do much of anything, but sometime in the next 2 years, we'll merge with another company. I don't know what that company is yet. Would you invest in the stranger's company? What if I told you that if the strangers complete a merger, they get to pocket 20% of your investment? That's essentially what a special purpose acquisition company, a SPAC, does. They're blank check companies that raise money from the public through initial public offerings. They generally have 2 years to find and merge with a target company. Once they find a target company, SPACs often raise more money through transactions known as private investments in public equity, or PIPEs. These deals give the new investors, mostly big institutions, not like you and me, an opportunity to put money into that target. But these new investors, the PIPE investors, they often can buy those shares at a discount to what the share price might be after the target merger. So they receive a benefit that's not available to ordinary investors. The result? PIPE investors often get a better deal than you, and the value of your investment may be further diluted. Thus beware. There are lots of costs that regular investors are bearing, whether it's that 20% sponsor fee, the dilution from the PIPE investors, and fees for the bankers and financial advisors. It may be that those fees are coming out of the retail public's investment dollars. We need to make sure that investors in SPACs are being protected. Look, you as an investor get to decide about where to put your money, but companies raising money from the public have to provide adequate disclosures. I think we can enhance the disclosures that companies raising money via SPACs make. I've asked staff for recommendations about how we might update our rules so that investors are better informed about the fees, the costs, the conflicts that may exist with these SPACs. We'll also work to hold bad actors accountable and keep a close eye on all the parties in these transactions. Because at the end of the day, we need to ensure that investors are protected.
So yes, the scoop is these SPAC companies are popping up. Individual investors see them, especially technicians, and get all excited because they can actually kind of manipulate the market. But at the end of the day, especially after all these PIPE investments come in, the losers are usually the company that has been acquired and the small investors that the SPACs got interested in the first place. And the winners is the SPAC themselves and then the PIPE investors. So you have to be very careful as individual investors. Thankfully, these things are not optionable, at least not at this point. But man, if they ever were, it's going to cause even more. You got to watch out because ever since the exchanges went public, they've been looking for more things to sell. And so, for instance, if you can remember back about 10 years when we had the Great Recession, that was because they created these financial instruments that were of these junk bond mortgages, and they kind of hid the bond mortgages into these financial instruments and got regular investors in the markets to invest in them. And so when the actual people were investing, they didn't realize they were investing in really crappy mortgages. Well, you just got to know what you're investing in. A lot of us technicians just like to buy and sell and make the money on the difference, but always know what the underlying is. The SEC is really worried about these SPACs because they really have no purpose of a company. It's like a whole bunch of, a bunch of people who get together and they're like, we could probably acquire a really big company. And one of the big companies now, I think it was BuzzFeed. BuzzFeed got acquired by a SPAC, and then BuzzFeed's been like, I mean, not only were they got piped, for lack of a better word, and so did the little investors who invested in the spike in
Yeah,
the SPAC.
yeah. From my understanding, it's kind of like a quick way to go public, right? Like these smaller companies, rather than being acquired, they'll create this formation of a company and then list it as the SPAC. Some of the names that I'm looking at that I think are popular are, it sounds like DraftKings is a SPAC,
Mm,
Virgin Galactic is a SPAC, Nikola, the Tesla truck competitor, came out as a SPAC, Open Door, and even the new Trump media organization, I believe, is a SPAC.
right.
Um,
So just buyer beware. When you're talking about the markets, it really comes down to buyer beware. So we always want to know what we're investing in on the underlying symbol.